Ladies and gentlemen, good day and welcome to the Q2 and H1 FY23 earnings conference call of Ethos Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Yashas Sabu. Thank you, and over to you, sir.
Thank you, and a very good morning to all. I hope you've had the opportunity to review our presentation and financial results, which are available on the stock exchange and our company's website. I'm accompanied by Mr. Ritesh Agarwal, our CFO, and SGA, our investor relations advisors, are also present on this call. I'm very glad to share the news of yet another excellent quarter, a quarter that confirms again the growth potential of the premium watch segment in India and the dominance of Ethos in this segment. We report with pleasure that our omni-channel platform, seamlessly combining offline and online, has done very well. We also report a higher share in the business, which differentiates our offering. Furthermore, our EBITDA margins continue to expand on the back of cost optimization initiatives and operating leverage. Here are the financial highlights. For quarter 2, revenue was up by 32% from 134 crores to 178 crores in quarter 2 of this year. EBITDA was up by 93% from rupees 15.4 crores in quarter 2 FY22 to 29.7 crores in quarter 2 this year. EBITDA margin for the quarter stood at 16.4%. PAT, profit after tax, for the quarter stood at 13.6 crores with a PAT margin of 7.5%. For the half year, H1 of FY23, revenue was up by 57% from 223 crores in H1 last year to 351 crores H1 this year. EBITDA was up by 117% from 27 crores in H1 last year to 59 crores in H1 this year. EBITDA margin for the half year stood at 16.5%. Profit after tax for the half year stood at 26.4 crores with a PAT margin of 7.4%. Inventory days stood at 162 days. Gross debt is rupees 9.8 crores. And cash equivalents, including other bank balances, are at 265 crores at the end of H1. Before we go to the Q&A part of our discussion, allow me these few comments, please. The luxury watch market in India is expanding rapidly. The overall industry is gaining traction with rising discretionary income of HNIs and a rapidly expanding base of these consumers. Watch buyers now know that luxury watches in India are competitively priced in comparison to other global retail destinations. Despite higher import duty and GST, India's prices are similar, mostly even better than other global shopping locations. The Ethos watch buying experience is equal or better than what consumers get anywhere else in the world. Ethos enjoys the unique trust of customers who believe that what we sell is genuine, it is sourced directly from the brands, and it will be supported by top-class after-sales service. As proof, I am delighted to share that 46% of our business is now coming from repeat customers, up from around 33% about 2 years ago. All of this places us in a unique position to capture the lion's share of the growth that this market will experience in coming years. We are observing carefully some slowdown in global markets, but we believe that the impact in India, if any, will be limited. Therefore, we continue to hold our guidance given earlier in this year. Our strategy continues to be to strengthen our presence in the luxury and high luxury watch segments. As a result, we expect a steady increase in ASPs, that is average selling price, over the next 6 to 8 quarters. We have accelerated our growth plans. Against the plan to add 13 stores as per our prospectus at the time of IPO, we are now targeting to add 40 new stores in the next 24 months across metro cities, and several new Tier 2 and Tier 3 cities are being added. We believe that they have a huge buying potential in the coming years. We are also continuing to strengthen our brand portfolio, especially our portfolio of exclusive brands. We are in discussion with several new brands for exclusive India rights and hope to be able to confirm and share many of these in the coming 2 or 3 quarters. Ladies and gentlemen, Ethos will not only be the leading luxury watch retailer in India, which we will be by far, but our goal is also to become one of the top 5 global luxury watch retailers. But our ambition, as you know, also extends beyond watches. You are all aware we have signed an agreement with Messika Paris to be the official distributor and partner for Messika jewelry in India exclusively. The addition of Rimowa luxury luggage to our portfolio is another category extension which will expand consistently. We will continue to take required measures for such expansion. These collaborations and others that are under discussion will help us build growth vectors outside the watch business to make Ethos a veritable luxury retail powerhouse in the years ahead. With these comments, I thank you very much for joining this call, and I open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment till the question queue assembles. The first question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Hi, good morning, and thanks for the opportunity. Season's greetings to everybody at Ethos, and congratulations, sir, for the company to host the Grand Prix 2022 last month. Hope the event went well. Sir, I had 4 questions. Should I go across all 4 together, or should I take it one by one?
Please, Rahul, go through all 4. Thank you very much for joining. Good morning.
Okay, sure, sir. So, firstly, on the new store expansion plans, I just wanted to know, what has led to the change, because that number looks like 40 stores in the next 2 years, quite a big number to achieve. So, if you could help us with some more detail in terms of location, capex, anything outside India we're doing, and the store mix between, are we, trying to do something, what jewelry luggage altogether? That's the first question. Secondly, on the CPO business, how did the segment do basically in the first half, and how is it scaling up? I heard on the TV as well that few training has been happening in Switzerland, but in terms of what's happening with the second lounge opening in Mumbai, the availability of servicemen, how do you see that business moving? That's the second question. Third and fourth are basically on numbers. The third question is on the same sales growth. If you could help us with the number for second quarter and first half. And lastly, on exclusive brands, within the 35 that we have, which would be the top 3 in terms of revenue? Those are my 4 questions. Thank you, sir.
Right. Thanks, Rahul. I'll go one by one. So on locations, but we always wanted to grow fast with locations, but frankly, until last year, when the effect of COVID was still sort of uncertain as to when it would subside, we were a little bit conservative. However, over the last 5 or 6 months, we are seeing a confirmation of our belief that the market is growing steadily. We are seeing that the leads coming in from many cities where we are not present continue to grow, not only for entry-level products, but also for middle to high-level products. And furthermore, we're seeing an interest from brands also to enter some new geographies. So as a result of these various combinations, we said let's go and up the target for new stores. We also believe it will help us to get market share faster by being the first mover in various cities where luxury watch retail is still not present. So as a result, we've, I said that we have a plan for about 40 stores. Some of these are already contracted. Some of them are in the process of discussion. But over the next 24 months or so, we expect these to come up. Many of them are in new cities. For example, there is Surat, there is Raipur. We are looking at Bhubaneswar. We are looking at Kochi. So a lot of new cities. We are looking at Ranchi, Siliguri. So these are cities, new cities, tier 2 and tier 3 cities that we're going to go to. And we will be strengthening our presence in most of the metros, most notably in Bombay, in Ahmedabad. Hyderabad is on the cards. Gurgaon is on the cards, and Mumbai as well. So I think all in all, we've got a fairly robust expansion program. It's also a combination of mono-brand boutiques as well as multi-brand stores. In the multi-brand stores, some of them are the Ethos Summit stores, and others are Ethos stores which will go up to luxury but will not include high luxury, especially in tier 2 and tier 3 cities. We will not start with high luxury, but we will go up to, let's say, from entry to luxury. So that's really the plan. We are, we had an outlay of CapEx in the prospectus. That's about, I think we had provided for about 33 crores. So of course that is there. There might be a little bit more, not too much more, which of course will come from our operating service. I hope that answers your question regarding locations. I'll now come to CPO. So CPO, the business looks strong and very good. There has been a correction in the, let's say, irrational exuberance that existed in this segment internationally. You are aware that for many of the collector brands and watches, the premiums were sort of increasing like at 5 and 10% a month, which was very, very irrational drop. That has subsided, that has corrected in global markets. While that has had a bit of a dampener effect in India because people were crazy about paying any price for watches. But in India, still the demand and potential remains absolutely unabated. Our bottleneck and something that is, of course, determining the speed at which we can grow is the availability of watchmakers and their training that is happening. As it is happening, we are stepping up our purchasing of watches. We had to slow it down because there was no point in purchasing watches if we didn't have the capacity to refurbish them. So we are now purchasing based on our refurbishment capacity. We are continuing to engage or look for watchmakers. That's not easy to find. We are actually now actively discussing setting up a training school for watchmakers in some form or the other, and we've initiated talks with some organizations in Switzerland that will help us to do that. So the CPO business will continue to grow steadily. Even this year, there will be high double-digit growth compared to last year. But it's not going to be meteoric. It will be a steady increase over the next 4 to 5 years. Every time, let's say, high double-digit growth is what we are looking at. Your third question was regarding SSG. The SSG is strong, very strong again in this quarter. We had an SSG of about 17.2%, and for the half year it's 44%. Of course, you'll remember that in the first quarter it was extremely high compared to last year, because the first quarter last year was still that COVID Delta impact. But overall, for this quarter, quarter two, it's more than 17%, which is extremely healthy. Your last question was regarding exclusive brands. I think we have a lot of exclusive brands which are doing very well. I would hesitate to call out specific names, but I can tell you that there are at least 5 or 6 of our exclusive brands that come within the top 10 or 12 brands overall for us.
Right, sir. And we would just request if you could share some takeaways from the Grand Prix, anything which we should know about, or anything which you thought were, basically leading to some more confidence on what we were doing in terms of business for CPO or new watches, either way. Thank you so much for answering my question.
Thank you. Thanks, Al. Thank you.
Thank you. The next question is from the line of Ankush Agrawal from Surge Capital. Please go ahead.
Yeah. Hi, sir. Thank you for taking my question. Firstly, sir, what I wanted to understand is, like, typically as an analyst, as an investor, what we have been accustomed to is general retailing in the market, wherein, a large part of growth is largely dependent on how many stores you keep adding. Whereas ours is a luxury retailing business, wherein I believe, the number of store addition is not directly linked. Like, we won't obviously have a lot of new store additions. So what I wanted to understand firstly is, if you can highlight some of the dynamics around our stores, like what is the CapEx, OpEx, like break-even sales, and what is the typical journey of a successful store? Because I have also seen that we have a lot of churn on the stores, which is understandable, given that it's not a general retailing. Every store will have success. So if you can highlight, like, what is the long-term journey of a store, a successful store, like how it grows typically in terms of long-term SSG growth and all that stuff. That is my first question. Second, do you want me to keep one by one, or should I put all?
No, please put all your questions there, and we'll go and answer them.
Yeah. The second question is around the gross margin expansion. So if I look at our history, I think even for last 4-5 years, we have seen consistent improvement in our gross margins, and you have already explained that it is because the increase in share of higher end of the watches, and also own exclusive brands, proportion of own exclusive brands growing. So what I wanted to understand is, is it something that can keep continuing? Because in our DRHP we mentioned that in our kind of business, the margin segment that retailers get is around 20 to 35%, and we're already touching 32%. So do you believe there's a lot of room for a gross margin to expand, or I think we are kind of hitting that upper limit? Right? That is the second question. And lastly, on the store expansion, so if you say you want to add 40 new stores, is this the net new store addition, or this is gross additions, and whatever closure that will have would be separate? That are 3 questions that I wanted to ask. Thank you.
Okay. Thank you, Ankush. So the journey of stores, you mentioned that there's a lot of churn. Actually, there isn't too much churn. Barring some changes that happen. Most of our stores which we have started, we've kept for a very long time. Journey of a store, it really depends on what format we're talking about. As you know, we have several formats.
Right.
We have monobrand formats. Now, these are really expressions of a brand identity, and a place where someone whose brand decided can go and pick up a watch. Now there, the journey is pretty sort of clear. It starts off and it grows as the brand grows. In terms of financials, overall financials are not that different in most of the key parameters, whether it's sales per square foot or margin structures or whatever cost structures. For multi-brand stores, we have an Ethos store and we have the Ethos Summit store. The Summit stores start with a portfolio which is higher in price point, and the Ethos stores are mid to high price point stores, right? But the journey pretty much remains the same now, especially that we have given up doing very small stores. In the past, we used to do multi-brand stores even with 500 and 600 square feet. We are no longer doing that. We do not do multi-brand stores below 1,000 feet. And wherever we see the potential for a flagship store, which is 2,500 square feet or so, we do a flagship store. Now, the journey is pretty simple. Actually, the store should start breaking even within the first year, and normally its payback should happen within 3 years or so. So we do expect stores to have a robust same-store growth. Our target is double-digit same-store growth. In the past, it used to be around 8 or 9%. We believe we will step up that same-store growth. Same-store growth is also helped by the fact that as a geography evolves, and this is a very, very important point to understand, as a geography evolves, we can continue to add higher price points, and eventually a store which could be an Ethos store can morph to an Ethos Summit store and continue to experience a strong same-store growth. Case in point, Chandigarh. Right. Chandigarh was not a great luxury market 7-8 years ago. We were selling mid to high price points, but not very high price points. Somewhere down the line, the market evolved, and we started to add more of the high price point brands. And even today, Chandigarh continues to show a high same-store growth, and we've been here for close to 15 years.
Yeah.
So the journey of a store pretty much goes along these lines. In general, we expect continuing same-store growth to continue for at least 7 to 10 years when we start a store. I hope that answers your question. Regarding gross margin expansion, you're right. There has been a steady gross margin expansion over the last couple of years. Where we stand today, it's actually what was our target 1.5 years ahead. So we've actually achieved a target of 1.5 years ahead today already. I think we are at close to an optimal gross margin expansion. However, and I don't expect that this will grow too much further. Of course, our profitability will grow through operating leverage, which is kicking in, and you can see that in the overall PAT or PBT margins or the EBITDA margins. However, I do want to add a little caveat that if the import duties go down, and the import duties are among the highest in the world, 23% is the basic import duty. If the import duty goes down, which we hope it will over the years, then we can expect a direct impact on the gross margin.
Okay.
Your last question was regarding new stores. Sorry, can you repeat the last question?
What I was asking was, if you're saying...
Sure. So we've identified 40 new stores. These are new stores.
Okay.
I cannot rule out that there will not be any closures. We don't foresee any closures in the next 2 years. There are let's say a couple of stores where the performance is not really optimal, and if these don't perk up, then we might close them. But it's going to be very, very few stores that we foresee closing down. Very few stores. Yeah.
Got it. That was very helpful. I'll get back in the queue for that.
Thanks for the question. Thank you.
Thank you. The next question is from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Yes, sir. Thanks for the opportunity. Congratulations on hello, sir. Congratulations on a very strong set of numbers. I have few questions. First one is strong results that we have witnessed in Q2. Is that on back of secular industry growth, or is it a result of market share gains for us? The second one is EBITDA margin performance has been quite impressive for us. So wanted to check on the sustainability of these margins going ahead. Also, if you can speak on how have been the discounting trends. The last time you indicated that it has been lower. So how did that behave in Q2 and how do you foresee going ahead? In terms of working capital, again, it's an impressive performance with inventory days remaining low at about 160 days and similar to FY22 levels. So wanted to check here that do we see them returning back to 170, 580 days that we used to do historically, or these are more sustainable? And second on working capital is payable days this quarter has reduced by about 20 odd days. So is it a seasonal thing where at Q2 end that does reduce and by the year end it goes up again? And lastly, I wanted to check on if you can share key takeaways from the GPHG event that we hosted, and wanted to check if global brands are viewing India as a more attractive market versus the previous perception. Yeah, so these are my questions.
Right. Thank you, Devanshu. I'll answer them as best possible. The Q2 growth, I think it's a combination of both. I think the market remains strong, but it's not only the market remaining strong. I think the ethos name and what it stands for is getting stronger, and therefore there is, of course, gain in market share. It takes some time to really estimate market share because there's not really too much published information in the watch business, but I'm pretty sure that it's a combination of a continuing strength in the market in India and, of course, phenomenal strength that the Ethos brand is now gathering. Margin sustainability. Broadly, I think, yes, it is going to be sustainable. There might be a bit of a variation. What you must know is that typically there is some losses that happen due to depreciation of the rupee. Historically, that has been true. In fact, during the last couple of months, except for probably September, the foreign exchange losses that we experienced were actually much lower. In fact, in Q1, there was actually a bit of a gain. So if I anticipate what could happen there could be a certain amount of loss, which will deplete the margin marginally. But I think overall we are pretty much in a sustainable zone as far as the margin is concerned. Working capital days, again, I think we will sustain this. As we add new stores and new brands, it may go up a bit because, there is initial stocking and then it takes time for the sales to build up. So during this growth phase, the number of days of stock may go up a bit, but we are within the target range, and even if it goes up a bit, in a 12-month period, it shall come back to this zone. Our overall goal, our long-term goal, of course, is to bring this down to, from the current level of about 176 to more like 160 days or something like this, 150 to 160 days. We believe this is going to be possible in the years to come. Payable days, it's gone down. One of the reasons is that with many brands, we do negotiate and try to work on improving margins by shortening the credit period. We believe that's accretive, especially now that we are in a comfortable position with the cash flow. But again, we don't see many big changes happening on payable days. There may be, marginal variations quarter to quarter, but I don't think there's going to be a big change. Lastly, the GPHG event, super successful. Next week, or actually tonight, I'm going to Switzerland for the international GPHG final event. I've been invited and be sitting on the main table, and this is in itself a sign that India is arriving on the world stage, and Ethos is very proud to be able to be the instrument to do this. So global brands are taking note. They are seeing not only India as a potential growth market, they are aware that India is the fifth largest economy in the world, but they're also aware that in India there is only one player of scale and international quality, and that is Ethos. So I believe the GPHG event has been super successful in showcasing not only India, but Ethos as the best international partner.
Really encouraging to hear that. Sir, last one bookkeeping question. So what are the CPO revenues for this quarter and share of exclusive brands? Also, if you can give some color on the other income outlook going ahead.
Can I suggest that Ritesh, our CFO, is going to collect these figures and give it to you? I can tell you already that the share of exclusive brands in this quarter is about 29%. So that is up from 26 or 25%, which was in quarter one. We expect this to stay at this level or possibly go up in the quarters to come. And again, for the CPO business, I think in the previous question, even Rahul or Ankush had asked about Rahul had asked about CPO business. We expect this year to clock about, for the year as a whole, to clock about 70 to 75 crores, which was 33 crores last year.
What is then on the other income, sir?
Devanshu, what do you want to know on the other income?
We have some cash reserves, so any outlook that you would like to give on the trajectory for other income for next 2 quarters?
So the available cash that has been parked in the fixed deposit as defined in the prospectus. So this is the market return that is there. So we expect that the amount which will be there, we will get the other income.
Got it, sir. Got it. Absolutely. Congratulations again, and thanks for taking the questions. All the best.
Thanks, Devanshu.
Thank you. The next question is from the line of Vinayak Mohta from Stallion Asset. Please go ahead.
Hi, am I audible?
Yes, you are, Vinayak.
Yeah.
Good morning.
So, congratulations on a great set of numbers. Good morning. So my question was more or less, regarding the ROC and ROEs. So given that we have upped our guidance on the expansion front, I see that, we'll be flowing in broadly around 250 crores, including the inventory, into the new stores, which would kind of keep the ROCs, depressed for a little while more. So just wanted to understand, we are right now at around 13-14% ROC with ROEs of 8-9%, assuming, 50-55 crore profit for the year. How do you see this, going forward? Do you think that this can go up to the 20% mark, and what would be the, drivers of the same? Like one is operating leverage, but apart from that, do you have something in mind that could, take this forward? And just confirming that you closed down 2 stores for the quarter. So specific reason apart from the, performance of the stores for the closures? Yeah. And any update that you have on the, newer brands, when are they going to start, and, how are you going to take it forward? Like the Remova and Messica, to be specific. And any other segment that you're looking at for now? So yeah, that would be 3 questions from my side.
Right. So let me answer the one on closures. The closures are essentially due to the lease expiring at a certain store, and in the similar geography, we've actually signed on another store which will become operational over the next couple of months. So there's no really net reduction. In fact, we moved to a better location in the same geography. There's just a reduction in this quarter. Actually, there shouldn't have been a reduction because 2 stores in Indore were supposed to start in quarter 2. Unfortunately, the launch of the mall has gotten delayed. So we hope that in quarter 3, by December, those 2 stores will start and others will start as well. Overall, we hope that 9 to 10 new stores will start. Most of them will happen in the quarter 4 of this year, which is when malls are promising that they're the malls will become operational. If they keep to their promises, we believe that 9 to 10 stores, new stores should start in before the end of this fiscal year. Your second question was regarding ROC. So you're right on the numbers. So, what happens is, first of all, obviously there is new capital. It's going to take some time to deploy. And when you deploy the capital in new stores or new brands, there's a certain gestation, like every project, before they start to become operative. Now, in the phase that we will grow aggressively, and I believe the next 18 to 24 months is going to be a phase when we're going to add a lot of new stores and we're going to add a lot of several new brands. This was, by the way, the basic logic behind the IPO and taking in funds as well, because the opportunity in India is there. There's nobody better than us to capitalize on that opportunity, and the time to do it is now. It needs resources and it needs structure. Now we have both, so we're doing that. So in this phase, we will see a rapid and an aggressive growth. We will maintain and probably improve the ROC and ROE, especially on utilized capital. And our long-term goal, of course, is that the ROC exceed 20%. And we believe it's very, very much possible. In the next 2 to 3 years, we'll start to approach that figure. Your last question was regarding newer brands. We are in discussion with several new brands, which we believe we should be able to share news as and when the contracts or the agreements are finalized. Remova and Messika, operations will start as soon as the malls are ready. Again, it's planned for Q4 of this year. Unfortunately, Remova will probably go into Q1 of next year because we're starting with the boutique in Mumbai, and the mall, which was supposed to be launched in February, March, is now, we've been told it will launch in April or May. This is, of course, the famous and the legendary Reliance Jio Plaza mall, which is going to be India's top luxury mall. So we are opening with Remova over there. And Messika, again, is something which we believe we will start in the last quarter of this year.
Understood. Just two more on that front. Do you think you need more capital to be raised? I see that you have decent cash at hand. But do you think you need more
plans? We don't have any plans for raising more capital in it.
Understood. And one last, so the payback for a successful store is 3 years, as you mentioned. But if we include the churn, is there a chance that it goes higher to 4-5 years, or that is included?
On an average, no. On an average, it will never go. There could be a few stores which it could be higher. Similarly, there are stores where it is lower, but I don't think the average will change a lot.
And this payback includes inventory as well, right?
Yes.
Understood. Okay, great. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Vikram Vilas Suryavanshi from Phillip Capital India Private Limited. Please go ahead.
Yeah, good afternoon, sir, and congratulations hi, sir. Congratulations on strong performance. I just wanted to know about this, our incremental investment in Kamla International. What is the thought process and roadmap ahead? And also, if you can give us numbers for Estima AG also in terms of revenue, EBIT and PAT. That is the first question. And second thing about, would you like to share more on this new plant, what we are setting up for manufacturing steel bracelet in terms of opportunity and scalability in that business?
Vikram, I have to remind you, this is an Ethos earnings call.
Yeah, that's why I also thought
we are not answering KDDL questions, but you know the company well, and I'm very happy to answer that offline.
Okay. Yeah. But about Estima AG and investment in Kamla International.
Those are also KDDL. Again, it's not an Ethos.
Okay.
It's not an Ethos investment.
Mm-hmm.
But very glad to connect offline and answer your questions, of course.
Sure, I will. Thank you, sir.
By the way, the KDDL numbers are also released today. So.
Yeah.
Does that answer your question, Mr. Suryavanshi?
Yeah.
Thank you. The next question is from the line of Sabyasachi Mukherjee from Centrum PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. So I have 3 questions. First, if you can help me understand the unit economics on store profitability. That is, what kind of capex is needed to open a store? What is the typical inventory? What is the sales per store, and what is the store level margins? That is one. Second is, if you can help me understand that how we are competitive in terms of prices with respect to global markets, despite having very high import duty and GST as well. Third is, if I compare our numbers, revenue and billing numbers between FY19 and FY22, sales and billings have almost increased by 32%, but the average selling price have almost doubled, which basically means that the volumes have come down between FY19 and FY22. I see the volumes are increasing in quarter on quarter, Q1 and Q2, they are increasing, but what are the major volume drivers as per your any thoughts on this? That are the 3 questions.
Sure. So let me, Sabyasachi, good morning, and let me answer your last question first, which is on ASP and volumes. You're right, ASP has gone up, has doubled, and to that extent have declined. This is a reflection of the implementation of a very conscious strategy that we adopted about 3 years ago, which was to reduce our focus on the entry-level price points and increase the focus on the high price points, the luxury and high luxury. Why did we do that strategy? Lower price points, especially price points below 30,000-40,000, those are price points that, number one, are being, let's say, that's where smartwatches are taking a lot of market share, and smartwatches is a different business from what we are doing. Secondly, it's the segment where you have a lot of e-commerce and you have other strong players in India. While in the premium segment, premium and high segment, which by the way is the fastest growing segment globally and also in India, there is actually no strong player, and we have pretty much the most important potential to and we are the most dominant player, and that's our fastest growing segment. So we decided to reduce our presence in the low price segments and increase it in the high price segments. Now, obviously in the low price segments, you sell much more quantity of 20,000 rupee watches than you would of 5 lakh rupee watches. If I sell one 5 lakh rupee watch, it's the equivalent of 125 20,000 rupee watches. So this segment, this shift in emphasis actually meant that the average selling price went up, the quantity went down. Most of the quantity has gone down only in the price segment below 50,000 rupees. In the price segments above that, quantities have gone up quarter on quarter. But overall, if you look at it, you will see it as a matter of quantity coming down. We are happy to do that because it allows us to focus on the fastest growing segment and not get too much bogged down with the fashion segment, which we don't feel is the future. So this is as far as the volume is concerned. As far as prices are concerned, the pricing in India is determined by the brands. The brand specifies the MRP, and most brands like to specify a very competitive MRP in India because they want to develop the Indian market and they see it as a very large potential market in the future. It is important that the prices are kept competitive. It doesn't mean that they are 20% below world prices, but typically they could be 2 or 3 or 4% below world prices, or at least within a plus minus 5% range. Compared to most countries, India's price is competitive. How is this achieved? Despite the high duty, it is achieved partly by the brand itself having a lower ex-factory price for India than they have for countries where the import duties are low. And partly, of course, the retail margins in India are lower than rest of the world. So we as retailers take a bit of the burden of the duty, and the brands take a bit of the hit in order to ensure that the Indian consumer has prices competitive with the rest of the world. As far as the unit economics is concerned, I'm going to let Ritesh, our CFO, answer that question. Is that all right?
Yeah, sure.
So our capex requirement for a particular store, average size is about 1,000 square feet, and capex would be about 1.2 crore. Inventory requirement is about 5 crore, and our break-even for the stores that comes within the same year generally, and payback period, as we discussed, it comes 3 years including inventory. So that's the profitability that we maintain. And growth in new stores at the first year would definitely be a gestation period, and then year 2 would be higher SSG, and then overall it will move to we see a steady SSG after 2-3 years would be 10%, so up to maybe 6-7 years.
Just following up on this, Ritesh. So inventory is 5 crores, you said. 1.2 crores is capex. If I adjust for the payables in the inventory and calculate the total capital employed, so roughly how much would be the total capital employed per store? Adjusting for the payables?
I would suggest if you can, there will be a lot of discussion which will take. So I would suggest, Satyasati, we can take this offline and we can discuss in detail.
Sure. I'll take this offline.
Sure.
Thanks a lot. Yeah.
Thank you. The next question is from the line of Ankush Agrawal from Surge Capital. Please go ahead.
Hi, sir. Thanks for the opportunity again. Firstly, can you highlight like what kind of scale up that we are expecting in a CPO business, like in terms of what could be the overall contribution of CPO business in the medium to long term? I think currently it's very immaterial at the moment, but the growth that you're seeing, could it be like 15, 20, 25% kind of business over the long run?
Yes, Ankush, definitely it can be. What I want to point you to is a study. I think it was a McKinsey study. If you check out McKinsey study 2022, they said that the size of the pre-owned market globally is already 1/3 the size of the new watch market in premium and luxury field, and it will grow to be 50% of the market in the next couple of years. Now, India, obviously, the market, it's a slower start, and it will take time for the CPO market to develop that. But I believe when you say medium to long term, if you're talking about like 5 to 8 years kind of situation, 15 to 20% definitely could be even higher.
Okay. And the dynamics of CPO business allows us a lower working capital requirement with a slightly lower gross margin, right?
Yes, correct. So far, that seems to be the case.
Okay. Lastly, just a clarification what CFO just mentioned on the SSG. So what you said, like after a store starts, after 3-4 years, you expect a steady SSG of 10%. Did I hear it right?
That's what yes, correct.
Right. So, like in the last quarter also you mentioned the statement that you expect your SSG, which was historically about 10-12% to grow to like on the higher like 17, 18, 20%. So if you're saying that SSG for new store would be like 10%.
No, Ankush. It was never that. I think you're mistaken. It was not SSG. The market was growing historically at about 8 or 9% in the past decade, right?
Okay.
I expect the market growth to increase and not to 17, 18%. I think the market growth will increase by about 11 or 12%. Our overall growth, I think, will go into 18% plus, which in past years was again more or less like 9-10%, sometimes higher.
Okay.
It's not SSG.
Okay. That clarification is helpful. Got it. Thank you.
Thank you.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, thanks for the follow-up. Sir, one question on the new store. Fundamentally, I understood about luxury that it's not about having more stores, but rather it's more about throughput, higher price points, and then, fulfillment obviously happen offline quite a lot. Should we assume, most of these new stores would be more mono-brand, smaller in sizes, acting as fulfillment centers, more about gaining mindshare in new cities and less of big bang flagship stores? And the sub part of the question is, how does CPO fit in this new 40 number? Is there a change in terms of CPO planning as well?
So, it's a combination of multi-brand and mono-brand stores. Majority is not going to be mono-brand. Majority is actually going to be multi-brand stores. There will be some flagship stores. It's very important that in new geographies we establish a physical footprint, because in new geographies, even if I don't stock very high priced watches, there is a market for those kind of watches, which you cannot really serve. It's impossible to serve it completely online, right? If you have a store, you have credibility, you have people to talk to, and you have people to network into. A good example of this is our experience in Guwahati. Right? Typically we stock mid-level to a few high-level watches, but not very high-level watches. But that doesn't mean we don't occasionally sell very high-level watches. Now that sale would be impossible if we didn't have a store there. Furthermore, what is going to happen in a market like Guwahati 5 years from now? Will there be a growth in the sales of very high-end watches? Of course there will be. But this growth is solidified and put in place and precipitated because we have a physical presence before any other retailer has that presence. So in a lot of markets, whether, as I said, Surat, Raipur, Bhubaneswar, Ranchi, Siliguri, it's really this plan to establish a base. It's not really only a fulfillment center. It's not a delivery place. It's an experience place. It may not be a 3,000 square foot store, but it will still be a 1,500 square foot store. And it will be bigger than anything else. I mean, right now, if at all there is a store selling even, 30 or 40,000 rupee watches, it's probably a very small store, unless it's a Titan store, in which case they're not selling premium watches. So I think this is a very, we are drawing experience from, cities like Ludhiana, like Guwahati, and we want to sort of capitalize on that. Does that answer your question?
Yeah, sure. And how does CPO fit in the plan?
So CPO, we don't need so many stores for CPO. So CPO, as we mentioned earlier, we've got the lounge in Delhi. The next one will happen in Mumbai and probably one or two other in the metro cities. The serving of CPO business will happen much more online.
Got it. Thank you so much. All the best.
Thank you.
Thank you. The next question is from the line of Aman Shah from GT Investments. Please go ahead.
Hello. Hi, sir. Thank you for the opportunity. Sir, really, congratulations on good set of results. Deepening the market and market share gain is encouraging. So what I want to know is our inventory days currently would be around on sales over last 6 months would be 160 days. As we see the same store sales growth also always picking up in our store, do we see this optimizations over a medium to long term after we have expanded on this 40 stores? Will that be a very good sort of optimization every year for a good period of time from 160 days?
We do expect optimization once this growth phase is over. Whether it's going to be a steady optimization forever and ever, obviously not. It's a luxury business. And, luxury business requires touch and feel. They require inventory to be there. They want the customers have to touch, feel, see it, how it looks on their hand. It's not possible digitally until I don't know when Meta will actually happen. Until then, I think it's important to have physical stock, and when you have physical stock, you gain market share. So I believe there will be optimization, and a lot of our analytical tools will also help in that optimization. But I think to expect that we will go down to 60 or 90 days of stock, I don't think that's going to happen. Please remember that we also enjoy credit from suppliers. So net paid days is actually less than the 160 of stock that you see. But medium to long term, we do expect a reduction in the number of days of stock for sure.
Mm-hmm. See, the reason, sir, the way I was asking is I see ourselves also becoming something like Watches of Switzerland, where they are a prime retailer in UK. Their inventory stock on sales is somewhere 95 days as of now. So,
straight away with you. Since you are studying Watches of Switzerland, you will notice that they have now started to make a distinction between supply constrained brands and non-supply constrained brands. Have you noticed that?
No.
Okay, please look at that. So a lot of their 50% of their business comes from 3 brands which are constrained. The demand is far more than supply, and therefore it's very difficult to hold on to inventory. Whatever you get sells out, right? And if 50% of my business comprises of such brands, then obviously my number of days of stock is very low. But on the flip side, what happens is if I'm not going to get supplies, how am I going to grow? So Watches of Switzerland is now saying, great to have these supply constrained brands. They give a great profit with very little working capital requirement, but if I have to grow, I need to grow with brands that are not supply constrained.
Sure.
So my suspicion is that over the years we're going to see working capital, number of days in Watches of Switzerland growing, and they'll be very happy about it because it means that their growth will then kickstart.
Sure, sir. That's very helpful. The second part, very quickly, sir. We said something like we want to be also top 5 global player. Does international expansion also right now, does it fit in this, or it's in ideation stage?
When I said top 5 global, I mean I don't think there's any country in the world that has the opportunity that India has. And I believe it would be wrong to not focus completely on the Indian market and extract the maximum benefit that we can from the growth that India is going to represent. Whether we will go to a neighboring country, probably it is on the cards, not immediately, but we will do that as the countries develop. I mean, Sri Lanka, the difficulties there, but I think that's a potential. But India itself has the potential and ethos to become a global player just operating in India in terms of size.
All right, sir. Thank you and all the best.
Thank you, Aman. We've got a couple of minutes left. I have to excuse myself. Can I request? I just seen Mr. Hiren Ved come on the question queue. Can I request Hiren? I want to welcome him because he's not very often in the seminar. So
sure. We'll take the next question, which is from the line of Hiren Ved from Alchemy Capital. Please go ahead.
Hi, Hiren.
Hi, Yasho, and congratulations on a great set of numbers. I just have one question. As we expand into adjacent luxury streams like jewelry and luggage like Remova and Messica, I know it's difficult to kind of say, but let's say in the next 3-4 years, how big can these businesses become with relation to what we have on the watches side?
And that's a great question, and we constantly debate this. Frankly said, I think you will start to see the size of these businesses on a graph, but it will still be, I would say, rather small in 3 years compared to the size of the watch business. The watch business is easily the largest potential that we have going. However, the business of branded jewelry is not for the next 3 years. I believe branded jewelry has decades of growth, and it also serves the purpose of our broad base in our client base, which is currently 75 to 80% male, to at least balancing it out to be 30 to 35% ladies. And branded jewelry, besides that, branded jewelry internationally today, among all the large luxury groups, whether it's Richemont Group, whether it's LVMH, branded jewelry is the fastest growing segment. So taking a cue from global trends, we're saying, let's get an entry into this. It's not going to be great in 3 years' time, but 6 to 7 years, 5 years plus, 7, 8 years from now, we'll start to be very happy that we started this now. Similarly, Renova, it's a brand of the LVMH group, the largest luxury group in the world. Getting this, and they still have 40, 50 brands that are very famous worldwide, not in India yet. If we want to realize our ambition in segments other than luxury watches, I think that connect is also very useful. So these are really long-term. We're not going to devote huge amounts of capital or energy. We'll see them growing steadily, professionally, and I think we'll start to see a takeoff in let's say 3 to 5 years from now.
Got it. And you think margins will be in and around what we earn on the watches segment, or?
I think margins would be a little better than the watch segment.
Okay. Thanks and all the best.
Thank you, Ren. Thanks for joining in. Guys, we've got 3 more questions. I have to leave early, so can we restrict it to 1 question from each, please?
Sure, sir. Participants are requested to please limit their questions to 1. The next question is from the line of Ajay Surya from Niveshaay. Please go ahead.
Hi, Ajay.
Hi. So congratulations on a good set of numbers. My question is regarding the exclusive brand. So I wanted to understand how this works. Like, is it like no one else in India will sell that brand, or there are certain products from these brands which we would exclusively sell? And do we have any kind of agreement with them, or how does the contracts are made? That's it.
So exclusive brand means that nobody else in India retails these brands. These are retailed exclusively by Ethos. Yes, there are agreements and contracts with these brands. And from time to time, they need to be revived, which is a normal process that we do. But yeah, most of them are governed by contracts.
And are we planning to look to add more brands?
We are. I mentioned that in the speech as well. We are in discussion with several brands, and over the next 2 or 3 quarters, we hope to be able to announce new brand collaborations soon.
That's it from my side. Congratulations.
Thank you, Ajay.
Thank you. The next question is from the line of Abhishek Gupta, an individual investor. Please go ahead.
Hi, Abhishek.
Can you hear me, sir?
Yes.
Yes. Thank you for the opportunity. I had a couple of questions. How many units of watches did we sell in H1 FY23?
H1 FY23, about between 24 and 25,000.
Okay. So why I asked is that we sold around 39,000 watches. So that 24-25 will take us to a 50,000 watch run rate, which will be out there 25% increase in our revenue. So I just wanted to understand, do you think these 50,000 watches have corresponding 50,000 end customers, or do you think there are obviously people buying multiple watches?
There are people buying multiple watches.
So how many would be unique customers in your view who would be buying these 50,000 watches broadly?
I'm not very sure, because then it could also be that is it only this, or are they repeat from someone who bought a watch in the last half year? But what I can tell you is that our repeat buying is 45% in this quarter. So the same customer has bought a watch earlier as well. If your question is how many new customers we add, I can get back to you on that, because we've got a loyalty program. We've got enrollment of over 90% in our loyalty program. So my estimate is that we'll probably add about 20,000 new customers every year, 20 to 25,000 new customers every year.
Because I think you used to sell around 70,000 watches in FY19, and that came down to 38,000 in FY22 because of the strategy you said. So I was just trying to understand that what are the end customers really, and how are we adding that exactly as you said, right? So that would be good to know maybe going forward. Because I think the actual traction or the business fundamental growth would be from you acquiring new customers. So that would be an interesting metric to track.
So if you're probably leading to the same question that we often ask ourselves. 50,000 watches in a year, while India has 5 lakh millionaires, millionaires, right? So shouldn't the quantity of watches go up? Of course it should go up. It will go up as, especially the younger generation is getting extremely interested in watches, not only as a symbol of achievement, but many times they also see it as a store of value. So we do believe that the quantities are going to go up.
And just another, if you could spend some time on the customer profile, do you see these large families buying those? And on the occasions, do you see weddings? Do you see just a store of value?
I can take one more question, and there's already one, Mr. Vinayak Mohta, for a follow-up question. So I'll be happy to answer that offline. I'll get out the airport to connect with you.
No problem. Thank you. No problem.
Thank you.
Thank you. The next question is from the line of Vinayak Mohta from Stallion Asset. Please go ahead.
Yes, sir. I just had a follow-up question on the payback period that you had mentioned. So as I could see that, you do 80-90 crores EBITDA, which excludes the, broadly 40 crores of rent that goes into the business, which would give you a broad, net EBITDA after rent of 50 crores, which is broadly 1 crore per store. So it somehow does not match it up with the number of the payback period, right? Because the payback period number should be 1.6 crores approximately per store coming over 3 years. So am I missing something here, or if you could just elaborate on it?
Vinayak, I'm going to let Ritesh connect with you, because the rental number that you're giving, I'm not sure where you get this from, because please remember there is this Ind AS 116, right? So maybe you should.
No, I'll take it.
I suggest you connect with Ritesh offline, and he will take you through the details.
No worry. I'll do that.
Okay? Thank you.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you, everybody, and I hope we've been able to answer the questions satisfactorily. I know that some questions need a follow-up, and our investor relations advisors, SGA, and our CFO, Ritesh, will connect for that. With this, I thank you once again for taking time to join us on the call. Thank you very much, and have a nice day.
Thank you. On behalf of Ethos Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.